Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson. My guest today is John Hyre, a tax attorney who caters to real estate investors, small businesses, and self-directed IRA and 401k investors. And the focus of his practice is on tax mitigation strategies. John joins us today from San Juan, Puerto Rico. John, great to see you. How you doing?
Glad to be here, and just living in Puerto Rico is part of my personal tax mitigation strategy. I don't pay federal income tax. I pay about 4 to 6% Puerto Rican tax. So gotta walk the talk.
Yeah, that's impressive. We've covered some of the benefits of investing in Puerto Rico on previous episodes of this show. It's been a few years though, so and I know they redid some of those acts from several years back. Maybe we can touch on that a little bit later in the podcast today. Well, this episode is going to be a little bit different than usual. I know usually here on this podcast we focus primarily or even solely on opportunity zones, and funnily enough, John Hyre is in my network because of a mutual colleague of ours, Ashley Tyson of OZ Pros, introduced us recently. And John, I think I've met you previous to that introduction or reintroduction from a couple weeks back. But you used to practice opportunity zones, but you no longer do. Tell us a little bit about how you view opportunity zones, first of all, and why you got out of practicing opportunity zones.
First of all, I love them. I mean, what's my favorite thing about opportunity zones? I can think of two off the top of my head. Mostly it's real estate people. They depreciate the living heck out of it. They get no gains in 10 years, including no recapture. So they depreciate a thing and they get a step up after 10 years. No gain. That for me is the bomb. I just love that combination. All the other stuff is secondary. You know, I always put it kind of like the benefit of 10 to 15 to 30%, depending on which OZ Act we're looking at, of the capital gain that you invest in it is forgiven. That's minor. I call it the JLO benefit. There's a great, big, beautiful back end, and that's tax-free after 10 years. And I love it. So QOZs, and then businesses, a business and an OZ that leases the space, and you can sell the business after 10 years if you do it right, tax-free, for example, a dental practice or whatnot. Those, for me, it just makes my day. It lights things up. So as a planner, I have to know about these things. I used to be a lot more into QOZs, actually setting them up, helping people comply. And what happened? It was actually Ashley's fault. And honest to God, we were both sober, I think. And I asked him a question, and his answer told me I need to either man up or get out, because a man's got to know his limitations. And what happened is that QOZs involve at least two complex areas of law. There's the OZ law with 500 to 600 pages of regs, which I followed, and I thought that was fine. Then there's partnership taxation, subchapter K, which is very complicated. And I get that. I've done that for 30 years. But once you mix the two together, on the one hand, it's like a Reese's peanut butter cup, the best of all, chocolate and peanut butter, glorious. Who thought of it? Give them a Nobel Peace Prize. But the complexity is like COVID. The increase in complexity from mixing the two is not linear, it's exponential. And I figured I either have to specialize in just OZs, kind of go big or go home. And so now I refer a lot to Ashley. I know when to do it. I know more than the average bear, but I have a real respect for the moving parts.
You know a lot more than the average bear. I think you actually took the time to read through the entire regulations when they first came out back in, what year was that? 2020 or 2019, 2021?
Yeah,
Who knows anymore?
You got it. 2019 and 20.
Yeah, way back when. Yeah, but you're out of it now.
I was shocked at how friendly the regulations were. Normally, regulations make things worse. These made things better. It was such an aberration. I enjoyed those.
Yeah, and we're recording this in August of 2025. We just had passage of the One Big Beautiful Bill Act a few weeks back on July 4th. We'll talk about that in a moment. OZ 2.0 is here. Opportunity zones are now a permanent part of the tax code, and we're currently waiting on some guidance from the IRS regarding how the transition period between OZ 1.0 and OZ 2.0 will work. There's a few high urgency items we're waiting from the IRS for. And then we'll probably get more sets of regulations throughout 26 and 27 to govern the new program. And I'm hopeful that those sets of regulations, given the administration's desire to make opportunity zones as great as they can be, I'm hopeful that the IRS regulators will treat opportunity zones very favorably and try to make the program as big as they possibly can. But I want to turn our attention now to that One Big Beautiful Bill Act, in addition to everything it did for opportunity zones, which we've covered ad nauseum on this show over the last several weeks. It did a whole lot more for a lot of Americans all over the country. All these tax cuts, some new stuff in the One Big Beautiful Bill Act as well. Not just OZs, right, John? Tell us what excites you the most about OB3, as I like to call it sometimes.
Making the pass-through deduction, aka QBI, permanent, that is huge. It takes away the uncertainty. You can tell you've got people who understand and like small business, even small to medium business. So the QBI is basically, if you make 100 grand net income from a business and it's not in a C corporation, you get a 20% deduction, which is more than a 20% tax cut because it's shaving off the top brackets. When you do the math, it's usually right around a 24, 25% tax cut for small businesses. That's just, so it's not exciting in the sense of, can I describe new provisions? Like, was there a new toy for me to play with? No, they just took a temporary toy that is a wonderful one and they made it permanent. And that is really good news for entrepreneurs. The bonus depreciation, the ability to do cost segregation, the ability to, and they're seeing already an increase in capital purchases based on the ability to deduct it. It encourages the right behavior. I like the Trump accounts. At first, I was a little skeptical. It took me a while to get them. It's kind of like the initial OZ statute. When the first time I read it, I'm like, what did you just say? But we're already getting some clarity from it. I really like the Trump accounts. I did not initially, but now that I'm understanding them, I like those a lot. I would say those are the
what are those anyway? What is a Trump account? Because my friend notified me about them during the original drafting. I think they were originally called MAGA accounts, if I'm not mistaken,
Yeah.
like back in maybe March or April whenever the House language first came out, and then it eventually got changed to Trump account. They're tax deferred savings accounts for children, I think. But tell us more about that. How do they work exactly, and who can benefit from setting up one of those?
So we'll give you a spoiler. The way they end up functioning is that when a child hits 18, the year in which they turn 18, so they'll technically be 17 still when the year hits, the year in which they turn 18, they're going to do one of two things. The most likely thing is convert it into a self-directed Roth IRA at a very low tax cost. It's going to be very low, maybe zero tax cost. So they're going to start at 18, depending on how long they've been investing, how much they've made, 90, 100 grand in a self-directed Roth IRA, even though they had no compensation, right? Normally to put money into a Roth IRA, you have to have compensation, a W-2, where you work for a business. And some people pay their kids, but some don't. So now rewinding to the technique. The account, the only thing I don't like about it, let's start with the bad. You have to invest in certain index funds. And my understanding is they will be sort of made in America sort of funds. I prefer to self-direct, but it's better than nothing. So what happens? You're allowed to put $5,000 per kid per year. Pretty much anyone can donate to it, but the total that you can put into it is 5 grand per year. It is after tax. You don't get a deduction for putting money in. So that hurts a little bit in the beginning, but if you do it, that's why it's so cheap for the 18-year-old to convert it to a Roth IRA. It has a high basis because the donations were after tax. So you really only have to pay tax on the conversion of income. So 5 grand a year per child from pretty much anyone who likes the child. After tax, it'll have a very high basis. And based on some very technical rules, it's a segregated account. And for the geeks, the real geeks out there, I'm talking about the IRA layer cake conversion rule, that if you convert one IRA to Roth, you convert all to Roth, and that can be highly taxable. By allowing you to segregate the Trump account when you convert it, it allows you to take advantage of that high basis. The other thing they can do once they hit 18, if you look at the list of things that you're allowed to distribute from an IRA without paying the early withdrawal penalty. If you withdraw before you're 59 and a half, there's a 10% penalty. But there are exceptions to that rule for emergencies and medical costs, buying a house the first time, et cetera, et cetera. And so if you fall under one of those exceptions, the distribution is functionally tax-free because it's high basis, so very little tax paid income tax-wise. and it's exempt from the penalty. So that's what it really is. It's a savings account for a child, not self-directed initially, easily converted to a Roth IRA. Self-directed is my preference, and when they're 18 is my preference, or as a fallback plan, distributions for various life needs at a very low tax rate.
And then they turn 18, or in the year they turn 18, there's 90 grand in there. And they can, and it's a highly tax advantaged 90 grand as well. And is the federal government putting money into some of these accounts when they create them, or when they get created, or how does that work, and who's eligible for those free government funds?
Any kid born let's say 2025 to 2028, so any kid born in those years who has a social security number gets one set up automatically by the government and $1,000 put into it, which is a nice little start and kind of reminds people that they have one and maybe they should do something with it. Interesting story behind the social security number used to be that the refundable child tax credit, which in English we call a handout, the refundable child tax credit, you did not need a social security number. And so a lot of people who were illegally in this country, quite legally, were adding their kids back home, and lots of them, to it, and getting huge checks from the federal government every year. They're actually, if you look up, there was an Indiana news station that did a really good expose on it, and it was perfectly legal. So just a little trivia, it helps people remember things, the trivia. The social security numbers are to make sure that only basically citizens and permanent residents get this break.
Sure, no, that makes sense. Okay, so my kids are out of luck for the free money. They were not born in those years,
Yeah, they already
but
exist. They
but
already
if
exist.
you have a kid that's born this year or in either of the following 3 years, 26, 27, 28, you get a little starter bonus from Uncle Sam. So that's nice to know. Uh, what else about the One Big Beautiful Bill Act caught your attention, if anything else?
I would say those are the big ones. Everything else was a bunch of good little stuff, a few tricks and traps in there, but for the most part, it ended up being a lot simpler than it seemed. A lot of it was just extending mostly good existing law and making it permanent so we have stability and we can actually plan. And then there were a few little new tweaks, but there was nothing else that really excited me dramatically.
Sure, sure. Well, we've been covering it extensively here, specifically through the lens of the opportunity zone industry and opportunity zone investing strategies. So we've got a very exciting time ahead of us, especially when we turn the calendar to 2027 and OZ 2.0 fully begins. But to zoom out a little bit from the One Big Beautiful Bill Act, OZ 2.0, a lot of the audience watching or listening to this episode right now, this podcast, they're real estate developers, they're small business owners, they're high net worth accredited investors, maybe they're family offices or family office executives. What are some strategies that you really like to help those types of people mitigate taxes on a long-term basis?
Two come to mind immediately, and if we have time, I could give you about 40 just off the top of my head, read a
Sure.
little and come up with more, but lawyers, we never shut up. One that comes to mind, which I take great pride in because I came up with it. Somebody who follows me is a Forbes writer, and he ended up putting it in Forbes. But I came up with it years ago, and I'm sure others did. It's a huge country, so let's not trumpet me too much. But it's converting traditional accounts, whether IRA, 401k, et cetera, to Roth at a huge discount. And this is important because traditional accounts that are tax deferred are inferior to Roth IRA, which are tax free. And especially in an inflationary environment, even if it's deferred, you don't really want to pay tax on nominal gains, but you are. That's how the code works. You don't just pay on real gains, you pay on nominal, which in an inflationary environment is expensive. So to give a baseline, and I'm going to use just a round number. The engineers on the call shouldn't get too excited about the number. I get the text saying you can only contribute this much to a 401k and so on. Just easy math. If you put 100 grand into a traditional account, you get a $100,000 deduction, but it's tax deferred, which is a problem. If you take that 100 grand, you put it into a traditional account, you get a $100,000 deduction, and then you say during the same year, let's convert that to Roth. Let's convert it to Roth shortly thereafter. You're adding 100 grand to your income. It's a wash. And by the way, for people who invest, even if they're in a high bracket, if they're making 12% or more on their investments, That conversion is usually worthwhile. Well, we have a better way. We have a much better way. It comes from estate planning. If you look at what estate planning lawyers routinely do, meaning there's a ton of case law on this, to make gifts to children smaller. They don't gift the kids, for example, a bunch of real estate. They stick the real estate in an LLC and they gift slivers of the LLC to the kids. And this generally cuts the tax effect in half. So think about, you invest in a syndication. The order is very important. And this is best described by example, especially if you want me talking for less than an hour, which you do. You take $100,000, you put into a traditional, whatever, 401k, IRA, combination, whatever. You get 100 grand in deductions. You then invest this 401k or IRA in a syndication. Could be real estate, it could be an OZ. If you're going to invest it in an OZ and it's an IRA or 401k, most of the time you're not going to get the tax benefit because most of the time IRAs and 401ks don't have capital gains. By the way, sometimes they do. I have seen some cases where there actually is a cap gain, even though it's a tax exempt account. That's a story for another day. They're investing in the fund because it's just a great fund. And this would apply to any fund, hard money lending, real estate, an operating fund, whatever. You invest in the fund with the traditional money. Now, intuitively, you would think once you invest in the fund, what do you now have to convert on your return? You no longer have 100 cash. You have an asset, an ownership piece of an LLC. But the law says if I convert an LLC interest in which I don't have control, I get a discount from the fair market value of 20 to 30%. So if you look at these operating agreements, the manager is pretty close to eternal. Right? Getting rid of the manager from one of these is really hard. You have to catch them doing something truly vile on tape twice and get a supermajority vote, including theirs, to get rid of them. These managers are more permanent than a government program. And so you truly have a lack of control. You are not the manager. Once you move the money into this LLC, you're a limited partner. You don't have a lot of say in how it's run. Well, tax law says because of that lack of control, you get a 20 to 30% discount on the asset value. Let's throw in, these are not generally liquid. You're not investing in the stock market. So these are not typically very liquid. All of these various funds, syndications, whatever you want to call them that we're investing in. Well, again, the tax law, there are just hundreds of cases that say when you invest in something illiquid, there's a 20 to 30% discount. So you add it up, somewhere between a 40 to 60% discount from fair market value. Okay, well, let's go through it. I put 100 of a traditional into a syndication. My starting fair market value is 100. Let's be optimistic today and say on the 20 to 30% scale, we're getting the 30% discounts. I'm just going to go with optimism. That's 30% for lack of control, 30% for lack of liquidity. That's 60%. So you go to an appraiser and you're not asking them to appraise the asset. You've already admitted the basic fair market value, it's 100. I just want them to appraise the discount, which is simple and cheap. You're typically looking at $1,500 to $2,000 for an appraiser to do this. So what's a 60% discount? I put 100 in based on tax law, not necessarily common sense, but tax law. I get a 60% discount, which means I report the asset, the conversion, because now I convert to Roth. I put the money in the asset, then I convert to Roth. That order is extremely important. What was the value of the asset that I converted to Roth? 40 grand. So I have a 100% Roth account. Normally, Roth accounts are all after tax. There's no tax deduction. What's the result here? I got a $60,000 tax deduction that I got to keep, but the entire 100,000 is Roth. Once you grasp that strategy, most people, if they're into investing in these kinds of assets, am I telling people to run out and invest in syndications to get a discount on your conversion? No. You invest in something because it's a good investment. Taxes are always second. The tax tail never wags the business dog, ever. But if you happen to invest in this sort of stuff, you should never invest in a Roth, whether it's a 401k or IRA. Again, you should do traditional, then invest, then convert at a massive discount. We have clients that put 300 and 400,000 into their retirement accounts per year. So think about the money we're saving them by having them do all traditional and then convert to Roth at these discount numbers. And I would say the discount number is usually pretty close to 50%. I didn't want to use 50% because it's a confusing number for people. So that strategy, it's just ridiculous. That's just one that we like to use. And it's a really good, because when I heard you tell me about your audience, I thought, I'll bet a lot of them invest in this kind of stuff. Or they promote these kinds of investments. And boy, is this a nice little sales point.
Absolutely, John. And I got to interrupt you there before you get to your second strategy, because I know you had two, and that's number one. But what you just walked us through, the ability to discount an asset based on these fair market value discounts because of lack of control and non-marketability of your shares in the syndication or fund that holds the underlying property or business or asset, whatever it is. That applies also to opportunity zone investing. We just had a masterclass call a few weeks ago with Blake Christian from HCVT, all about how to reduce your tax liability on your opportunity zone investment in 2026. As a lot of my listeners may know, and if you don't know, stick with me for a second. I'm going to walk you through this. As you know, when you make an opportunity zone investment under OZ 1.0, so you make an investment prior to the end of 2026, part of the benefit that you get is a deferral. That the deferral, that gain isn't forever. That gain eventually comes home to roost. You owe a tax liability on that gain at some point in time. Specifically, the statute says you owe it on the deferral date, which for everybody in 1.0 is December 31, 2026. But what is the amount of gain that you recognize on that date? It's actually limited by the fair market value of your opportunity zone investment on that date. So the same concept applies. Okay, well, what's the value of my opportunity zone investment? Because I don't own this building directly. I own shares in a QOF that owns shares in a QOZB that owns shares in, or that owns the asset, essentially, right? So what's the value of my QOF shares? It's not necessarily 100% of the value of its underlying assets because of these issues, because of lack of control, lack of marketability. So Blake, on this OZ Insiders Masterclass that we had for our OZ Insiders members a few weeks back, was walking through a lot of these same mechanics and how they're going to apply. And there's going to be this whole industry, I think, that's going to pop up in 2026 that's going to be valuing OZ assets, but then also valuing investors' shares or interests in qualified opportunity funds for a very similar purpose. Hey, how much can we reduce the amount we owe in 26, right?
It's exactly what we were just talking about, slightly different application.
Yep, exactly.
And here's what I love about it. In the estate planning world, there are hundreds of cases on this. And then there's case law that says these estate principles of valuation apply in the income tax world. Here we are.
There we are. And I told you we wouldn't be talking too much about opportunity zones, but I couldn't resist. I had to tie that last one into OZ strategy.
You can't not say that.
That's true. That's true. All right. So that's strategy number one that you like to recommend for a lot of your high net worth clients. What's this? I love that one, by the way. That's a great one. It has application in a lot of different parts of investing, including OZ for 2026 specifically. What about number two? What's your second tip?
I actually employ this one personally. So I get a great tax rate when I'm in Puerto Rico. For example, a client calls, I provide services, I'm physically in Puerto Rico, which I track on the calendar. I pay the Puerto Rican rate. However, for example, I'm putting on an event in Atlanta in September, which has to do with a lot of these ideas, but in horrifying detail with a lot of Q&A. That is physically in Atlanta. Puerto Rico does not have jurisdiction over Atlanta as much as Puerto Rico would like to, or maybe not. I don't know. If you've seen Atlanta lately, I don't know. But I can't get the break there. So what do? I put most of the profits from that in my 401k. There's something called a Rollover Business Startup, a ROBS. It is, in my case, and in most cases, it's a Roth 401k, and this is really important. It's a Roth 401k, because if you get into ROBS online, there are two big flaws with most of the information. Most of the 401ks they use are traditional, which is lunacy, just absolute, like I'm talking malpractice level, lunacy. Those need to be Roths. Second, most of the 401ks online are not self-directed. I vastly prefer alt investments, including OZ zones, including real estate syndications, you name it. So in my case, what I do, I have a Roth 401k. It owns 98% of a C corporation. I own 2% of the C corporation. Now, there are technical reasons why you don't want the 401k to own 100%. So there are reasons you don't want to know, TMI. The C corporation, let's say I make $1 million providing services or speaking or practicing law for that matter. It makes $1 million. C corp rate, let's just stick with federal to keep it simple, is 21%. I'm going to round to 20% just for easy math. I make $1 million inside the C corp. The C corporation pays 20 grand or 200 grand. There's 800,000 left. 98% of that goes into my Roth 401k. 98%. 2% goes to me. What are the two things I've achieved? Here's the little benefit. 21% tax rate. For some people, that's a really good tax rate. That's a side benefit. That's a bonus. What's the real benefit? In my example, I am jamming 800 grand a year, or just shy of that, 98% of 800 grand a year into a Roth 401k. It can go invest in syndications. It can go invest in whatever. It's tax-free for the rest of my life, plus 10 years, at least plus 10 years. The ability, so think about that. I'm jamming 800 grand per year into my Roth 401k. And now there are details. What's the key? That in that C Corp, you're doing one of two things. You are providing services or you are selling stuff. You don't do rentals or Bitcoin or oil and gas royalties inside of the C corporation. You do services, which in my case, that's what I'm doing. I'm speaking, or I'm providing legal services, or you sell a bunch of stuff. And there are ways to bifurcate existing businesses. Before I moved to Puerto Rico, what I had contemplated and what I routinely do for clients, I was going to keep my existing clients in an S Corp. And I live off of that money. And I was going to put new clients into the ROBS because there's no law that says all my clients have to go in one entity. In fact, I've got a fair amount of law from way back when that says entities are a choice. What do you want to run through which one? You're flipping houses. I can flip one here. I can flip one there. So I was going to put all my new clients in the ROBS and live off of the old clients that are in the S Corp and just have this parallel siloed structure. That's a very basic explanation because we really get into nuances. Can I lend money to the C Corp? My answer is like, I don't like it. You can sort of, but I don't like it. Can I rent property to the C Corp? I prefer you not. You can, but it gets a little dicey. So there are a lot of, as is the, with great power comes great responsibility. A zero tax rate in 98% of the income. I get taxed once at 21%, then it's zero as it grows. That's great power. Now, similar to the QOs, in fact, what's the reason I didn't go into QOZs? I spend so much time in this world and on these rules for self-directed IRAs, HSAs, rollover business startups, et cetera. That's where my focus is at. And there are so few lawyers who do this. It's a lonely world. Like we mostly know each other. We talk to each other mostly. There are a few of them that we kind of don't talk to. But the power of that structure, if you qualify, there are always the caveats. It's ridiculous. I'm going to spend in Atlanta. That's one of the main 3 topics. We're going to talk about a lot of different topics. Ashley will be speaking there. We invited him to talk about OZ 1.0, OZ 2.0. And of course, we're waiting with bated breath to see if we can make, the jump from one to the other, depending on how they interpret certain laws. And so I look forward to having him there. 26th to the 28th of September in Atlanta. If you want me to expound on these techniques and bring up a whole lot more, 26th to the 28th, you can come in person or virtually. If you can do in person, the networking is sick. It's going to be a lot of real estate guys, a lot of high net worth guys. Interestingly, what's happened, it's kind of morphed over the years. we get into such sophisticated techniques that CPAs, CFAs, and planning lawyers tend to show up. In fact, that's probably half the audience. And that's in spite of the fact that I don't offer CPE, CLE. They don't get credits, and they come and see me anyway because they learn so much for their practice. So it is advanced. Like if you're a newbie, you can go, just understand you'll bleed from the nose and ears. And so bring, handkerchiefs or something. But we will go into, for example, ROBS very heavily. This year, we're going to really focus some on hard money lending. There are a lot of subtleties inside and outside of the IRA. We're going to get into the taxation of pleasure farms. That doesn't sound right. That sounds so Epstein. Let's just go in a different direction with that. We're a farm, like for example, in my case, a retreat for the family, but that I still want the tax benefits of a farm. But we're going to get into a whole bunch more. It's going to be a lot of Q&A and just as many tax planning techniques that I've seen come out over the last year. I don't just follow the case law. I actually, for cases that interest me, pay pretty significant money to pull the transcripts, the cross-examination. I want to know what the IRS lawyer asked the taxpayer. What were they digging for? I get into the memos, that the IRS and taxpayer pretrial briefs, the memos. I go deep. And so I'm going to share that in Atlanta. A lot of back and forth on these kinds of techniques. If people are interested, I think you'll have something, a QR code in the show notes, and it's taxreductionlawyer.com. Taxreductionlawyer.com, virtual or in person. We'd love to save you all money and maybe have a little bourbon. That's been known to occur.
I'm sure there will be bourbon there. You said taxreductionlawyer.com.
Taxreductionlawyer.com. Yeah.
Okay, and we'll have a special link from the show notes page on our website as well at opportunityzones.com/podcast. Sounds like a great event. Ashley Tyson will be there. He's one of my favorites. The ROBS and self-directed IRA industry sounds a little bit like the Opportunity Zones industry. Everybody talks to each other except for a few guys, and it's pretty close-knit community. I got a chuckle when you said that because it's similar to the OZ world in that regard. I would say, who is best suited to go to your event? Is it just for professionals, or is it for family offices and accredited investors as well, or who do you think would benefit most from being there?
Small to medium-sized businesses where the owner wants to be a little more hands-on with the taxes. Now, if you have a really good CPA, send them. That's why we have some there. I mean, for their own practice, or we have an owner, because some of the business guys are so good at the deal and no good at the paperwork, and taxes count as part of the paperwork. And so that may or may not work for them. The ones that are a little bit more hands-on or don't feel that their CPAs quite got it, or the ones that want the real networking, certainly accredited investors, certainly the professionals, probably not a great fit for pure W-2 people. If you're pure W-2 people are hard to help. W-2s, here's a rule in tax law. The simpler it is, the more likely you're getting hammered.
Mm-hmm.
The more complex it is, the more likely we can play glorious games, which is why when they put out 500 to 600 pages of regs for the OZs, for example, I was delighted. I'm like, oh, that's room to play, because they're going to create gray and ambiguity and room for us to maneuver and do things. W-2s are very straightforward. Those guys are harder to help unless they're considering getting into business in the near future. Now, the IRA conversion idea I gave was a little bit of an exception to the rule. I think that would help any of them.
Yeah, I was gonna ask you, actually. Thanks for coming back to that. Those two strategies you walked us through, the traditional to Roth at a discount, and then the second one was the ROBS, rollover business startups. What type of person is best suited for either or both of those strategies?
So the conversion is anyone who has significant size traditional accounts or Roth accounts and they like to invest. For example, the accredited investors usually also have, whether it's at their job or at their business, they typically have accounts, IRA, 401k accounts. Now, this is more for the self-directed ones, although under the new Trump directive, we're going to see more alt assets in regular 401ks. So the new Trump directive to the Labor Department was, you guys have made it too hard for normal 401ks to invest in alt assets. I want you to change it. Now, we don't know what will come of that. He's given a broad order as his tendency, and someone else does the details, as it generally should be. And so let's see what those details are. But I do think that alt investing should become much more available to a normal 401k. So I think this discounting applies to anyone who's got retirement money and would like to get Roth, but at a much cheaper price, which is a broad audience.
Yeah, it's a very wide portion of the United States.
Well, and the syndicators love it. I've
Mm.
presented for a number of syndicators because when they're investors here that look, in addition to a great investment, hopefully, right? Not all of them are, but hopefully a great investment. There's this tax benefit that gets their people excited. The ROBS are good for anyone providing a service or selling goods as a business. So if you have a business or are going to have a business that sells goods or provides services, I'll give you an example because I was thinking about syndications. If you're a syndicator, you are the general partner. You're the one taking the, 2 and 20 or whatever it is that they're getting. You could run your general partner, the owner of the general partnership interest could be a ROBS. You're promoting a syndication, could pour money into the C Corp, pay 21%, and then it goes up into your Roth 401k. Anyone providing a service. Now, in my case, I'm licensed, and in my case, I figured out it was okay to run my practice through a C Corp owned by my 401k. If you're licensed, we got to find out if you can even do that because some states are very strict on certain licensing. But in general, if you have a service or you are selling stuff as part of a business, a ROBS makes a lot of sense for you.
Well, John, you've been a wealth of information. Appreciate you joining me today. We're just about out of time. If there's anybody in the audience who's curious about learning more about you, maybe they want to work with you. How does that process go? What's a good first step for onboarding a new client potentially or a new prospect? And what's the best way for them to get in touch with you?
I would get a hold of me through taxreductionlawyer.com. We are right now, let's see, it is August 28th. We're in a bit of a transition. I'll have plans to announce in right after the event or during the event that will change how they reach us. So there's just a little, I don't know, foreshadowing of the good sort. But yeah, right now, just taxreductionlawyer.com is a good way to reach me. I will say this, for the rest of the month, I'm insanely busy. And then after that, there should be room to take clients. And I do put out other material. I have an online entities piece that is, good Lord, what did I put into that? Like 18 hours of content all about entities, including how to maintain them. Nobody ever talks about that. So there's just a ton. You ask a lawyer a broad question like that, and you know how we are.
Absolutely. Well, John, again, it was a pleasure having you come on the show today. For our audience out there today, if you enjoyed today's episode, hit that like button, give us a thumbs up. We're going to have show notes available for today's episode at opportunityzones.com/podcast. I'll link to John's website as well as his conference in Atlanta coming up later in September. But please also be sure to subscribe to us on YouTube or your favorite podcast listening app to always get the latest episodes. John, again, it's been a pleasure. Great talking with you today. Thanks for joining the show.
Thanks for having me. Take care.